asked today to field a question about whether the market's going to go up or down and how can I tell? And there's an old adage in the market that says well, the market is going to go up and it's going to go down. We just don't know what order it's going to be. So, but seriously, the stock market did have a nice rally the last 2 weeks. But I don't want to throw a wet blanket on the earnings of the past 2 weeks, but we're still in a bear market. As Ryan mentioned, there's a lot of question marks still. And so I do want to talk about the potential for a stock market crash. This is something that comes up frequently in conversations. Most of the time, it's not a big deal, but my thinking on that is starting to change a little bit. First, let me point out that there's no real definition of a stock market crash other than a big, hairy drop. That's a technical term there. And also, stock market crashes are not random things. There are specific factors that are contributing to the biggest crashes that are not there normally. And I also don't predict market crashes. I merely note when the factors contributing to past crashes are present in the moment. Now, when I talk about market crashes, next slide shows what I call the big ones. You can see 4 of them listed here. This doesn't include the biggest of all crashes, which was 1929, which was an 89% drop in the Dow Jones Industrial Average, the biggest, strongest stocks in our country. Anyway, the average of these 4 crashes is a 58% loss, meaning an index fund investor during these crashes lost 58% of their savings. Now, investors who thought they could just buy and hold during these bear markets often had life-altering experiences, the kind of experiences that send you back to work or force you to go live with your kids, things that I wouldn't wish on anyone. Now, I'm thinking a stock market crash is a small possibility because some of those factors that were hallmarks of past crashes are showing up in today's economy. The biggest one in my mind is weakness in our financial system. And there's 2 primary drivers behind that. The first is the unfolding crisis in commercial real estate loans. Most banks and insurance companies have huge portfolios of commercial real estate loans. And office buildings and retail centers are underwater in a really big way and creating big problems for banks with those loans. The next slide shows the rise in high-risk commercial real estate loans. And these numbers here are the numbers of banks that are in these different categories. The green line here shows the number of banks with over 300% of their capital in high-risk commercial real estate loans. And that line is rising significantly. Now, to put this in perspective, if a bank has 300% of its capital in these lousy loans, and they lose just 1/3 of those loans, that bank is insolvent. Okay. Right now, this chart from S&P Global shows that as of the first of this year, there were 282 banks in this high-risk category. That's a lot of banks, and I know things have gotten worse this year, not better. I just haven't seen any more recent numbers from S&P Global on this. This next slide shows what the stock market thinks of the banking industry. The green line is the regional banking index ETF, and it's down 43.91% from its 2022 highs through the close of last night. The S&P index of large banks is the yellow line here. It's down 35% even. And for a little perspective, the S&P 500 index in red up here on this chart is only down 8.63%. So Wall Street does not like banks right now, and I tend to agree with them. The second factor is government spending and debt issuance to support that spending. According to Fox Business, the 2023 deficit was $1.7 trillion, and that amount needs to be covered by selling IOUs in the form of treasury bonds. Now, this is an increase of about 23% in a single year, about half of which was new bonds issued just to pay interest on old bonds. Now, Albert Einstein said the most powerful force in the universe was compound interest. We now have compound interest working against us with this spiral. As a result, investors are demanding higher rates when lending money to the Treasury. That's increasing the cost to service all of the debt the Treasury has. And this has created a vicious cycle with deficit spending pushing up rates, and higher rates push up deficit spending, which pushes up higher rates, which pushes up deficit spending, and on and on and on. Now, the biggest crashes in history, 29 and 2008, were all accompanied by financial crises. And we just touched on two humdingers that are brewing right now. Now, my best guess is that the potential for a serious stock market crash is only around 10%, which is not a high probability, but it's way higher than zero, which is where it was. And this is what's got my antenna twitching so vigorously. Where there's smoke, there could be fire. Now, the next slide shows how I like to protect myself from market crashes, and that's to have insurance. And the form I prefer is called hedging, using investments that actually go or usually go up when a market goes down, such as this S&P 500 hedge shown in red on this graph. The S&P 500 is in blue, as you can see, one is a mirror image of the other. One just goes up when the other goes down, and that's why we call it a hedge. Hedges can offset losses in other invested assets and stabilize a portfolio, allowing an investor to continue to hold their better assets without taking huge risk in doing so. But if we were to own 50% of the S&P 500 and 50% of a hedge like we've shown here, the rate of return will be about zero. And shooting for zero rate of return is not a good investment strategy. But if we can hedge the weakest investments and hold the strongest investments, good things can happen. And let me show you how. This next slide shows the retail index in early 2009. This is a chart from my college class that I used for many years. During this period of time, the retail index dropped 14%. The next slide shows the technology index. The technology index dropped 17% in the same time frame. Nobody in their right mind would want to own those investments when they're dropping like a rock. But if we compare those to the S&P 500 on this slide, we can see that the S&P 500 dropped 27%, much more than the retail or the tech industries. Retail and tech are in red and blue on this chart, and the green line on the very bottom of the shaded area is the S&P 500. With some thoughtful hedging, we can capture that shaded area as a gain. And let me show you how we do that. If we were to combine 50-50, the retail index and our inverse S&P 500 hedge, which is shown in yellow on this chart, the retail index is in red, we would end up with what looks like the green line. That returns 8.43% during this period of time. But look how smooth that green line is. That's what we're after. We don't want these wild ups and downs, which scare investors, including our clients, out of the market at the wrong times. A smooth rate of return is much preferable to a rough ride. On the next slide, we can see that combining the tech index in red and hedging it with an inverse S&P 500 fund in yellow, we will earn 6% on the green line, while the S&P 500 was losing 27% of its value. Now, that's a good way to invest when the stuff is hitting the fan. That's a really good way. It's a simple concept. It's just not easy to execute it in real time. And that's why you need professionals like us, I guess. But insurance has costs. Money allocated to hedges does not earn interest like cash would. And hedges can lose value if the market goes up instead of down. Now, I'm always struck by investors who are willing to insure their house and insure their car, but they're not willing to insure their investment portfolio, which often is worth much more. My estimate of a 10% probability of a stock market crash that could cost an investor half of their savings is enough for me to want to take action, because as an old financial planning adage says, always insure things you can't afford to have happen. Losing half of one's life savings is something no one can afford, and not insuring it, I think, is foolish. Now, the worst case scenario with Shadow Ridge's hedged portfolio is that the market turns up instead of going down like we anticipate, and we lose a little bit of money instead of earning a lot of money on those hedges. And we could close those hedges out real quickly as soon as we see that develop. So we don't hold them all the way to the bottom like a buy and hold investor might. Now, losing a little bit of money on hedges that didn't work is not a bad outcome. Losing more than half of your savings, that's a bad outcome. Now, it's been said that misery loves company, and that may be true. In every bear market, I hear clients of ordinary advisors saying, well, everybody else is losing money too. Well, yeah, it might be right, but I believe that misery is still miserable and something to be avoided. Now, for those of you who are already shadow rich clients, quit worrying. We've got this.